Welcome, everyone. This is Anton Madley with Peak Market Watch. I'm here with my colleague John Martinez. How are you doing, John?
Hey, you doing great, Anton. Good
Good.
afternoon to you.
So let's talk about the Fed and where the rates are going to go.
Our
Uh,
favorite subject.
our favorite subject. That's right.
So what are we like? Well, what are we close to about a week out now?
Yeah, that's right. So they meet again on the December 13th and 14th, right? And the big question is obviously by how much they're going to raise the rate. Is it uh, 75 basis points, which everyone thought until a few weeks ago, and now with some of the cool down, people feel, well, it might be just 50 basis points. But there is the individual who works for the Wall Street Journal, Nick Timiraos, right, who is, well, a lot of people now call him the Fed Whisperer. And so he has some insight there. So why don't we quickly share the
Sure.
uh, what he what his take is on it, and then we leave it up to our listeners to decide what number they are comfortable with.
Yeah.
Yeah. So this is the from yesterday, right? And when we look at it, clearly Federal Reserve's officials have signaled plans to raise their benchmark interest rate by 0.5 percentage point at their meeting next week. That definitely is a change from a while ago, right, John?
Oh yeah, definitely. Because our conversation last month, we were both kind of in the camp that it felt like um, higher for longer a bit, and most likely at that 0.75. So interesting that we're getting this a week out, and I think the article noted that they're out of their quiet period. So I'm sure the tea leaf reader is reading all the leaves he can get, and I'm happy he was able to get this article out.
Yeah, yeah. And obviously, whatever Chairman Powell is communicating in between these meetings immediately has an impact, right? We have seen the Treasury rates coming down quite a bit. We still have that volatility. And one of his comments was obviously Fed Chair Jerome Powell indicated last week that the central bank was prepared to downshift the size of rate increase at its coming meeting in on December 13 and 14th. So the market is extremely focused on these comments, and it's extremely volatile. Right, we talk here about changes of 30 to 40 basis points within a day, which is pretty amazing considering still how relatively low the interest rates are. Uh, and I think one of his comments also was, right, it's very difficult not to over tighten, right? We think that slowing down at this point is a good way to balance the risks, right? And just that comment, obviously, everyone has taken immediate face value. Okay, so now it's going to be maximum 0.5%. Do you see that it could only be a quarter, John?
You know, I I I would not guess so. My my own gut feel is that it's still a need. I mean, we saw the confusion and the communication the last go around. That was our follow-up conversation last month. I would imagine that if there were a lower cut of only a quarter, I think that would basically be so dovish that you would allow the market to begin to run again. And and I think there are other things in that have to kind of play themselves out. We there were a number of economic items that seem to have been addressed here recently. One of which I think was important was the federal government stepping in and interceding in the labor dispute for the rail industry. So that was potential huge potential constraint in our supply chain that could have further gummed up the works into the front part of next year. So I don't know that we're out of the woods there, but there seems to have been a hand put on the scale in favor of keeping the supply chain moving. And so while that's one positive, I'm sure there are other positives as well. I would not think that a quarter basis point cut is aligned with the comments, especially during the Q&A from Chairman Powell.
Yeah, yeah, I tend to agree with that. Right. Uh, Obviously, then next week, then they also look forward, right? As it's highlighted here, officials are likely to next week how much to raise rates in February. And naturally, the pricing pressures are key piece. You mentioned the railroad strikes, but other labor pressures only is still very much on their mind, right? So if inflation shows, but the labor market stays tight, they could be more divided over how to proceed, right? And I think that, in my opinion, that's likely where the overall shift is going to go. Obviously, we have had prices going up on energy over the last year, but now in starting March, we will start to see because it's always measured year over year, whereas only the increase compared to a year ago from March is only not nearly as much when it comes to energy and maybe also some other goods. But when it comes to labor market pressure, we possibly could see that there is only continued wage pressure there, which we haven't seen yet a year ago or March of next year a year ago, right? So that will be pretty interesting to see how they look at the labor market. And obviously, as we have seen a week ago, the labor market is still really strong, right? So
Right.
So that, I think, I agree with you with the labor market still being strong, even if they decide on 0.5% raise rather than 0.75. I just cannot see that they will go below that with such a low unemployment rate where we still are.
And
Right?
and and not to add too many variables for you to juggle on, Tom, but you did comment during our last conversation about one of the recent prior conversations about how the Fed is not setting rates in a vacuum. So there are other international pressures. I think one of those might have been, or maybe one that we might look at would be, cost of energy uh, in Europe. Through the winter, you might be paying attention to this more than I have. I can't say that I've noted anything exceptional, but have you seen anything that just anecdotally pops up on your radar as far as how Europe is setting with the winter setting foot there?
Yeah. I mean, there is still pressure for raises, right? Because inflation pressures only is still pretty significant in Europe. It's very much energy driven at this point, but we have also seen that labor shortages are also popping up left and right. Right, as an example, right? I'm from Switzerland originally, and they now have a struggle for public transportation. So they are actually shortening some of the schedule because they do not have enough people that operate all their trains and trams and buses, right? So it's only is a obviously that is not necessarily a measuring stick of where inflation is going to go, but it's definitely Europe has the energy cost issue that is continuing to be a problem, as well as labor pressure too, and that combined, definitely they are seeking higher rates as a result of that. Energy is very interesting, right? So if you have a week or two of warm weather, then energy cost drops immediately, natural gas, and as soon as there is a cold spell, then it jumps back up. I would say that's probably happening here in the US too, right? but there is only a lot of pressure for higher interest rates in Europe, which then puts also quite a bit of pressure, obviously, on the Fed, that they are in line with everyone else in Europe, right? So what is also interesting, right? So clearly they are, and again, the Fed whisperer, right? So Nick, he has some insight. He talks to various Fed officials. So it's very clear that not everyone is on in the same boat as right now of where it possibly can go, right? But like something, right, that the supply chain situation will ease very quickly, which would then rapidly decline the inflation rate, and that we get much closer to 2% next year. And whoever is in that in that corner of the opinion, they definitely would prefer a quarter point raise in February, right? So obviously with that said, I think many probably feel 0.75 is too high, and apparently that's what the discussion is, that many oppose a 0.75 raise this month. So I personally feel it's more likely that you see 0.5 this month, and depending on how numbers come in from a labor market and from CPI, producer price index, that it's either a quarter or another 50 basis points in February, right? But I think as a base, we solely should assume, in my opinion, again, that we are at 0.5 this month and at least a quarter point in February, and that February number might be 0.5, who knows, right? But I do not see that be combined between these 2 months that we will be less than 75 basis points.
And in as far as like a traditional cycle of what folks start looking for as we move through the calendar into next year for that, maybe that February, I would imagine, here soon, before the major holidays take root here in December, we'll start getting feedback about, how retail sales were as far as online, brick and mortar storefronts. And, did the consumer show up and spend, or, was there confidence there? And, does that in turn continue to feel pressure on pricing for labor, or, do we see a little bit of a weakness? I don't know. I honestly don't know.
It's a good question, right? And like when we look back to Black Friday, Cyber Monday sales, they had record sales, right? So there certainly is not a weakening in consumer spending as what Jerome Powell and probably many of the Fed officials would have liked to see, right? From at least from a rate raising perspective. So there is only there is no doubt that the spending that is taking place over the next couple of weeks also has some influence there, right? I mean, the reality is it's still, the job market is still really strong, at least when we look at the official numbers. And you would think that whether you believe that number or not, the reality is that companies struggle in hiring quality employees, right? They may have access to more employees, but not necessarily the quality employees. And as long as that is the case, that wage pressure, I think, is going to continue.
Well, yeah, I think we need to have an index that's tied to the number of items on a kid's Christmas list, because I'm about to get mine from my son here this week, and I'll try to let you know next time we meet up whether or not year over year that was up or down. I'm going to go with that. It was at least flat to up. So
yeah,
I think that pressure continues. I don't think there's ever been a year over year decline, but you never know.
Yeah. Okay, great. So why don't you start that index?
I'll start that up. No problem.
Okay. Very good. So, our listeners, what's your opinion? Leave a comment right below and tell us what you think. Obviously, as an investor that has it's continually impacting us, but reality is whether it's a 50 basis points this month or 0.75, the impact is not that significant as it was when the first few rounds of raises started. And let's see where we will be in February, right? That a lot of things can happen in that time frame, right? So thanks again, everyone, for watching, and see you soon.
Thanks, Anton. All right, Anton.